One of the things I love about value investing is that Mr. Market is constantly giving me gifts. And by that, I mean Mr. Market he's very seldom stupid. He always has a good reason for what he does, but he is often wrong. And by that, I mean he's often irrational. He may have a reason for it, but at the end of the day, his reasoning is flawed. Now, most of the time he's right, but there are some select opportunities that do come our way that we can take advantage of. And today I'm going to share two of these opportunities I think that Mr. Market is really overlooking. Before I get into the video though, if you want to get regular dividend content, both in terms of picks like I'm going to share with you today, comments on ETFs and CEFs, investing philosophy, mistakes I've made in the past, secrets of successful dividend investing, how I've managed to beat the market over time, please subscribe to my channel. You'll get at least 2 videos a week. Thank you so much. I really appreciate your viewership. Okay, so the first one I'm going to talk about today is Canadian Natural Resources. Now, this is a stock I haven't talked much about here on the channel. It's ticker symbol CNQ, and it's traded both in Canada and the United States. It's actually a Canadian company. It's an energy exploration and production company, and it's a really wonderful company. It has very long reserve life and its assets over 30 years. It operates primarily in low-cost oil sands in Canada that have very low depletion rates and gives it a very long duration, low-cost production structure of energy resources. Yes, it has a lot of oil, but it also is involved in the natural gas and LNG spaces, which gives it nice diversification and helps it to throttle up and throttle down its production of these various energy commodities based on current pricing environments, etc. So that alone makes it a quality business. It's done a good job of growing over time, and this is illustrated by its dividend growth track record. It's grown its dividend by about a quarter century at a very aggressive pace over that time. It has one of the most impressive dividend growth track records really over the past quarter century of any stock out there. And despite that, it has a current yield of about 5%, which is a compelling bargain for an energy production company with the growth track record that CNQ does. It has a strong balance sheet, a very shareholder-friendly management team that in addition to paying out that attractive and consistently growing dividend, has bought back a lot of stock in recent years and continues to be positioned to buy back stock if it feels that its stock price warrants that. So you're going to get a very aggressive company in terms of they invest strategically for growth. They recently made a great acquisition of some assets from Chevron that really were accretive to shareholders, but they're also very aggressive in terms that they are returning capital to shareholders, all while maintaining a strong balance sheet and growing the production profile over time. Another reason I really like them, again, like I mentioned, is that they have a very low cost profile. And so that means that even if energy prices were to tank, CNQ would be in a position to remain profitable much longer than most others would and be able to support its dividend much longer than many others would. So that's another reason I really like CNQ. Now, why is CNQ a bargain right now? Well, energy stocks in general have taken a hit over the past 6 months or so, and that's largely due to the concerns that the Trump administration has talked a lot about increasing drilling. And if they do increase drilling success, that's going to bring down the cost of energy, which hurts energy producers. Now, there's obviously a counterweight to that, okay, well, how successful is President Trump going to be? He can't just, in the United States, he can't just seize energy companies and force them to increase their output. Certainly, he can create incentives to do so. He's working hard to do various things along those lines. But even if energy output increases, it's not entirely a loss for energy companies because, again, energy demand is growing by leaps and bounds due to the AI boom, global economic growth in general. And also, it's important to keep in mind that increased production, sure, maybe it lowers the price, but you're selling more oil that way. So that also can help improve, volume side of the equation for energy producers, even if their margins take some of a hit from increased production leading to lower prices. On top of that, a more friendly government structure in the United States can help to reduce costs, increase access to profitable projects, et cetera, for energy producers. So it's not all a loss for energy producers. The other big concern, though, with the CNQ is that it's a Canada-based company, and President Trump has talked about putting tariffs on imports, trying to increase domestic U.S.-produced energy, and so that could be a headwind for CNQ. Of course, it can sell its energy to other countries as well. It's not like the U.S. is the only client, but that would add extra hassles and potential expenses involved there. So there is some risk, but again, I think that a lot of this is just rhetoric. It's a negotiating tool. President Trump has shown himself very quick to threaten tariffs, but then very quick to drop them once he gets his way in terms of an agenda that he's pushing for the United States. And so I wouldn't worry too much about these tariffs crushing CNQ. I think that they're going to be just fine. And even if there are tariffs, they're going to be very short term in duration. And so over the long term, CNQ should be just fine. while you wait, you collect that nice 5% dividend yield with strong growth expected over time, potential buybacks, et cetera. I think CNQ is well positioned from a risk reward standpoint. The other stock I'm going to mention today is a renewable energy company. So if you get both of these, you're going to have balance between the hydrocarbons play and the renewable play. Brookfield Renewable Partners. Now, the big fear here with BEP, or BEPC if you want the K1 free version, BEPC issues a 1099 tax form. It's a C corporation. The big fear here is that President Trump, once again, has had some rhetoric that has said that, we're going to go after wind power. He's already issued an executive order that banned offshore wind, and he's also going after federal leasing on wind power projects. Now, the good news for BEP is that, first of all, only about half of its business is in the United States. It also has a large business around the world, Canada. I mean, Brookfield itself is a Canadian-based company, certainly a significant presence in Europe, but also a growing presence in Asia, South America, and around the world. But the other thing with BEP is that only about 20% of its FFO comes from wind power. And so, and even less of that percent is US-based wind power. And so it has really good diversification, has very low exposure, relatively speaking, to US wind. And it's also important to note that this is on new projects. So existing wind farms are not, you're going up there and dismantling them all and tearing them down at a complete loss to the investor. Now, those power purchase agreements are long duration in nature. They're locked in. And even a lot of its development projects are probably past a point where they could be just shut down. And so BEP is in good shape there. I mean, its development pipeline is only 21% wind power. So again, it's roughly the same as what its current cash flows are. So again, I don't see a huge hit to their growth. In fact, they have so much growth potential from many different angles that it's just a matter of prioritization. And so I really don't see this meaningfully hurting their thesis at all. Their investment, in fact, their existing wind power projects may even be worth more if new ones are not able to be built. And again, Trump has not banned wind power production or even development in the U.S. He's just simply said on federal lands, and potentially some of the regulations could be such that it would make it harder to do so, but it's not a complete end of wind power in the United States. So again, even that is overstated. But on top of that, you need to look at BEP's other businesses. Their crown jewel business, nearly 50%, is hydropower. These are high-quality assets, perpetual in nature. They're like real estate assets. They appreciate over time. Very favorable recontracting environment right now because of the demand for power. It's a clean power at that, and these are well-located, moated assets that they can do up financings on over time as they appreciate value to unlock capital that they can redeploy elsewhere to invest. Brookfield is the king of doing that. And so that's a part of it. They also have Westinghouse stake, which is a renewable power business, arguably one of the best in the world for nuclear reactors. And so that's going to be a big beneficiary of the AI boom as well as nuclear power is in high demand. They have solar, they have battery storage, and they have some other ancillary smaller businesses that are growing. And so they have so many ways to deploy capital to take advantage of the demand for clean, reliable energy that, a little bump on the road for wind power is not really an impact to them. On top of that, they have very good relationships with leading tech companies. For example, Microsoft recently signed a record-setting power purchase agreement with Brookfield to produce renewable power to fuel their AI investments. And so that's a huge deal that they have under contract that's going to fuel growth for the years to come. They have inflation-linked escalators on their assets. They have business plans for improving efficiencies. They have recontracting tailwinds. They have development tailwinds. They have the ability to capital recycle because of Brookfield's vast empire across the world. They can always be buying and selling assets where it's favorable to do both to further accelerate the compounding process. So Brookfield Renewable Partners has so many tools in its toolkit to continue growing. On top of that is a BBB plus credit rating, which is by far the best in its sector, tons of liquidity, very well-laddered debt maturities. And so it has very few threats to its business. It can easily weather the storm, easily shuffle its resources around, but thanks to the market's pessimism, it now yields about 7%, which is an incredibly high yield for BEP relative to its history and makes it one of, if not the most attractive high-yielding stock in the market today. As a result, I really like BEP. It's one of my largest positions. And honestly, I may buy even more, even though I already have been buying a lot here recently as it's dipped into the low 20s and really close to $20 per unit. And so, I think BEP is a great buy right now. Okay, so hopefully this video added value to you. If it did, please give it a like. Please subscribe to the channel to get more opportunities like this moving forward. Between CNQ with its 5% yield and impressive track record, setting you up for some of the highest quality hydrocarbon energy assets in the world for the coming energy boom. Meanwhile, you get BEP, which bounces out with some nuclear, hydro, wind, and solar, and battery storage and other exposures, some more advanced clean energy technologies. but that one is also expected to grow at over 10% per year while offering a 7% yield. So you get both BEP, perhaps a little bit more speculative in terms of current environment, although its long duration cash flows with its contracted assets makes it perhaps even a safer bet than CNQ, which is more commodity price sensitive. So they balance each other out really well. Again, hopefully they added value to you. Let me know in the comments below what you think. Thanks so much. See you next time.